Today I'm going to talk about how I handle my CPF savings and also essentially review the amount of money I have in my CPF accounts. After revealing my investment portfolio and then my cash holdings, this was another thing that I wanted to do for the longest time, and I've procrastinated until now where CPF is now very big news, so I might as well talk about it now. Now, a little bit of background for those who don't know my employment history. I've been self-employed most of my adult life, and I only started paying myself a salary in around 2019. So about 4-5 years of CPF contributions. Yeah, so not as much as most people around my age, I think, but still a significant part of my retirement plans. And yeah, I'm just going to talk about how I'm handling my CPF savings. Now, I'm going to start with my biggest account, which is my CPF Medisave. And even as a self-employed person, it is compulsory to contribute to Medisave if you want to renew your license. So I was an insurance agent last time and I had to pay my Medisave contributions in order to renew my license. So that's the one thing that I contributed right from 2009 when I started working. And as a tutor, when my earnings became more stable, I decided, okay, let me pay myself a salary and contribute to all 3 CPF accounts, including my CPF Medisave, because I saw that they were an important part of my retirement as well as to pay for my medical bills in future. So over the years, with all the contributions as well as the interest, I now have $51,533. The current basic healthcare sum, BHS, is set at $71,500 this year and is set to increase each year, but there's actually no requirement to hit this amount. In fact, being under the BHS means that you have more room to contribute to your Medisave for tax relief, and that's actually what I did last year. On the last day of 2023 last year, I contributed about $2,700 to my Medisave account. This is for some tax relief purposes. And yeah, I don't normally contribute to CPF, but I will do so if I can get substantial income tax savings. And last year, I was lucky enough to have a high enough income that, yeah, tax was a bit high, so I decided to reduce it using CPF contributions. Now, money in your CPF Medisave account can only be used for a few purposes, and one will of course be for healthcare costs. The second will be for insurance, and that's what I did. Okay, I have bought Income Shield for about 10 plus years now, and that's on top of MediShield Life, which is the compulsory healthcare insurance that we have to buy, right? But I think it's not enough, right? You should definitely upgrade with a private insurer, and in my case, I've chosen Income for my Shield plan. About 3-4 years ago, I actually downgraded my plan from private hospitalization to restructured A ward. And I think this is a topic for another day, but that is for me to manage premiums, and I save about $400-500 in premiums every year. Subscribe to my Telegram group if you want a future piece talking about the pros and cons of downgrading. Yeah, so I think that's too long a topic for me to discuss today. Another insurance that you can buy when you hit 30 onwards will be CareShield Life, and I have the default CareShield Life plan, and I've been meaning to upgrade it, but I'm a procrastinator. So yeah, I'll get around to doing it, and I hope by making this video, I'm pushing myself to do it. The default CareShield Life currently pays $649 per month if you're severely disabled, which means you cannot perform a few activities of daily living, such as moving yourself to the toilet, feeding yourself, wearing clothes, etc. So these are related to old age disabilities. Fun fact, it used to be called ElderShield because the policy started at 40, but they brought it forward to 30 and therefore renamed it as CareShield because ElderShield sounds very horrible for people in their 30s. Now, the cost of elder care can be quite costly in Singapore, so I think it's always worth it to use your Medisave premiums to cover yourself so that in future when something like that happens, you don't have to use cash to pay for all these things. I will choose my plan very soon, so subscribe to my Telegram group if you want a future piece detailing my reasons for choosing the plan I chose as well as the amount I picked, etc. So yeah, subscribe to my Telegram group. This video is brought to you by Webull, which is giving you $2,500 of Tesla shares when you fund $100,000 and maintain it for 1 year. Alternatively, you can fund $2,000 and get $100 of Tesla shares if you maintain your funds until 31st March 2024. After you become an existing customer, you can also get up to $3,000 of free Tesla shares when you transfer in stocks from other brokers, and you even get a subsidy of $200 to offset the fees you incur when you transfer your shares in. See the description box below for more details, and thanks to Webull for sponsoring my video. Next, I'll talk about my ordinary account, and my OA currently has $32,697. Since I bought my property about 4 years ago, I've already withdrawn $68,597 on my home property. This includes $35,000 which I paid as part of my down payment, and then another $33,600 as ongoing mortgage repayments to my bank. And then there's this thing called accrued interest. Now, I've talked about accrued interest before in a previous video, and I'm very comfortable with the idea of accrued interest because, unlike what some people will have you believe, you are not really being charged an interest. Again, it's too long for me to explain it here, so watch that video if you want to know more about accrued interest. But in any case, this is how much I've withdrawn for my property purchase from my CPF OA. Now I can actually do this thing called a voluntary housing refund where I can pay up to the amount that I've withdrawn plus the accrued interest. But I'm not going to do that. Instead, when I sell my property, what happens is that this amount will be refunded into my OA, and then the rest I'll get back as cash. Once that happens, this 74,000 that has been refunded to my OA can then be used to buy my next property. And I'm not going to do a voluntary housing refund because I believe that cash on hand is currently better than CPF OA savings. Now that being said, I'm actually not using my CPF to pay for my housing installment, even though I believe that cash is king right now. And the reason is very simple. I just want to build my CPF OA savings for a rainy day fund. Having about $30,000 in my OA means that if there's any disruption to my income, right, I can actually go 1+ year without having to worry about my mortgage. And I think that that is something that you can consider doing instead of just paying out from your OA until it is nearly zero. Now, of course, you can have these backup savings in form of cash, but cash has too many competing uses for it, whereas OA is only specifically for housing, right? So I think it is a better place for me to earmark funds for emergency savings for housing purposes. Now that I've reached about a year's worth of mortgage, I'm now going to resume using my OA contributions from my day job to paying my housing installments. And yeah, then I can use my cash to do investments. Now, of course, amounts above 20,000 can use to buy things like T-bill or even go and invest, okay? But again, I'm a procrastinator, so yeah, I will do so with the extra $12,697 shortly. And finally, the special account, which has been in the news recently, right? I have $37,044 in my SA. Now that I think is not a very high amount because like I've mentioned, I have not been contributing to CPF for a very long time, and I have never topped up my SA until last year, again due to income reasons. Last year, I topped up about $5,300, which is the leftover amount from the $2,700 I contributed to my Medisave account because I can only enjoy $8,000 of tax relief on my own CPF contributions per year. Personally, I don't feel that it's wise for young people to top up aggressively into their SA to chase the FRS when they're still young and early in their working career for a few reasons. First of all, time is on your side when it comes to riskier investments like stocks and shares, right? In the long run, stocks and shares have outperformed things like treasuries and government bonds. If you are nearing your retirement in your 50s or 60s, yes, by all means rely on your CPF for your retirement. But if you are 20 or 30 in the prime of your working life and still have decades to go, why are you settling for just 4% per annum return from your CPF? Now, there's this thing called the rule of 100 where you take 100 minus of your age to derive your asset allocation between riskier assets and lower risk stuff. So if you are in your 30s, you take 100 minus 30 and 70% should go to higher risk stuff like equities and 30% should go to lower risk stuff like bonds. Now you can actually change the number 100 to reflect your risk appetite, and for me I've changed it to 120, so I'm 36 this year and therefore 120 minus 36 means that I should have 84% in riskier stuff and 16% in lower risk stuff. Personally, I treat my special account savings as part of my bond allocation in my investment portfolio. Your normal CPF contribution should actually help you maintain this rule of 100 between your SA and riskier investments that you do on your own with cash when you're in your 20s or 30s. And when you reach your 40s, it's not too late to actually start topping up at that time. Also, don't forget that you can only top up to the prevailing FRS, so there is a limit to how much you can actually top up in your lifetime to get tax relief. And when do you want to get your tax relief? Obviously, when your income tax bracket is on the higher side. Now, of course, this differs based on your personal circumstances, but many people actually reach their peak earning ability in their late 30s and 40s. So I guess it's quite appropriate that now that I'm in my late 30s, right, the 36 to 40 mark, I made my first SA top up. Getting old. Finally, topping up to your CPF also comes with this thing that we have talked before, and it is policy risk, right? Unless you've been living under a rock, you should know by now that CPF SA will close when CPF members turn age 55, and this closes a CPF shielding loophole. Until 2025, CPF members who turn 55 can do this thing called SA shielding, where they prevent their SA money from being transferred to their retirement account, and therefore they can use their SA to store money for 4% per annum interest and still be able to withdraw anytime they like. Now, this loophole will be closed for everyone from 2025 onwards. So yeah, if you are far away from age 55, this has nothing to do with you, more or less. Yeah, but if you have been someone who have been topping up their SA expecting this loophole to continue, you're out of luck because this loophole will no longer be available from next year onwards. Now, technically, you can still shield lah. You can still put it into your OA, which gives you 2.5% per annum interest. Right now, it's not fantastic, but when you turn 55 and bank rates go to like 1% or under, like it did a few years ago, then actually 2.5% is still not too bad at that time. But I think it's quite clear by now that CPF's intent is for you to lock up your savings for a long time for your retirement. So yeah, do go into your CPF with this in mind. So for me, I'll continue to top up to my SA to make it around 15 to 20% of my entire portfolio because I'm following my rule of 120. And of course, on years where I can have substantial tax savings because, right, if you're at the 19.5 tax bracket, you can just get 19.5% instant returns, which what other tool can give you that? So in total, I have $121,000 across 3 of my CPF accounts. And given how I only topped up last year and didn't do anything special, I think this shows the magic of actually automatically contributing and letting money compound over time. And that really, I think, is the true beauty of CPF, where you're actually forced to set aside part of your monthly income to this place. And over time, you realize that it grows to a pretty significant amount for your home buying, retirement, and medical bills. Right? I still think it's not enough, so you definitely should invest on your own. And for more details on that, right, subscribe to my Telegram group where I talk about how to invest your spare cash soon. And also check out this video where I talk more about CPF. So I'll see you in that video.